More market moves thanks to Nvidia and AI, but can they continue? Welcome to Market Insight. I'm David Pollard. The surge to new peaks by AI chip leader Nvidia plus softer than expected US retail sales data pushed the S&P 500 and the Nasdaq to record highs on Tuesday, with that momentum continuing today. Nvidia is the standout performer, though Dell and Supermicro were also seeing strong gains after Elon Musk said they'd provide server racks for the supercomputer his startup xAI is building. Well, joining me now is Young-Yu Ma, Chief Investment Officer at BMO Wealth Management. Welcome. Nvidia's stock price has nearly tripled so far this year, powering gains in the broader market. Supermicro shares have more than tripled in value during the same period. Dell stock has nearly doubled. Can these stratospheric gains be sustained?
That's a very important question for the markets because they have been driving, the small set of stocks have been driving so much of the gains, Nvidia particularly. We think there's a lot priced in here. There's certainly some risk, but if you look at the AI trends and the projections for how much spending is going to go into AI and how much we expect the actual usage throughout the economy to expand over the coming years, there's really a very long runway, and we're in the pretty early innings. So a lot is getting priced into the stocks, and that adds an element of risk, but we do see the trends as very strong multi-year trends. So it's difficult to call a top here despite in those names, despite a lot being priced in.
Nevertheless, there are concerns about the US market's lack of breadth, with so much of the overall performance concentrated in just a few stocks. Does that lack of breadth matter at all?
Yeah, that's a related question because again, with a lot of these, the small number of stocks driving so much of the gains, a lot of stocks in the majority are really having a somewhat lackluster performance this year. And whether or not that can extend in terms of broadening the breadth that we have so far, we think it can happen. It is a concern right now. I wouldn't say we use it as a timing tool because this narrowness can go on for a very long time. But we do think as the Fed starts to cut interest rates later in the year, if inflation prints continue to have the favorable numbers like we saw in the last print for CPI, we do think breadth can improve here. But the narrowness is concerning. I wouldn't say it's a reason to get out of the market, but it is something to be a little bit cautious about and see how the developments take place. And hopefully we go toward greater breadth rather than greater narrowness going forward here.
Well, as you say, markets have been buoyed by a more benign inflation outlook. In fact, you still see a September rate cut as possible, despite the Fed's latest dot plot suggesting a much later cut in the year. What is your thinking around that?
We think a September rate could be possible. We would need essentially a string of favorable inflation prints for June, July, August. We think if we got 3 in a row after coming off the May inflation print, we would indeed get a cut in September. But if we get some choppiness in the data, there can always be randomness, even though the trajectory of inflation is down, which we do think will continue. The Fed might be a little bit on hold. So the Fed is going to err on the side of being slow and cautious unless we get these inflation prints that just come in consistently favorable over the next few months. We think it's possible, but right now we'd probably consider that a toss-up here.
One potential fly in the ointment for both the Fed and for markets is possible election risk in November. Or indeed, is it? Do you see markets simply coasting through that period, doing business as usual?
Well, there's a lot of uncertainty. We think as we approach the election, say we get into September and October, the markets will probably take on a bit more of a cautious tone, investors not wanting to take big positions in front of that election uncertainty. We do think the majority of the outcomes for the election are probably relatively benign for the markets. But the reality is there are some outcomes for the election that could result in potential for driving up interest rates, potential for putting a bit more inflation pressures back in the system. There are some outcomes that the market would be concerned with. And given that, we think we'll probably get some caution as we move into the September, October months in the marketplace here.
Finally, Young-Yu, let's look at sectors you like. Tech in there, of course, industrials you also like. Where do you see value? Why do you see value if this market rally broadens out?
Well, if it broadens out, we think there are a lot of spaces that can do well, but we think industrials, which have pulled back a bit recently, are due for a bounce here, especially the subset of industrials that really focus on grid enhancements to the electricity grid, the build out of data centers. We think a lot of those areas spending is going to stay consistently strong for years to come. There are some areas we're cautious on, which we think consumer staples, for example, have relatively high multiples. We think the growth probably isn't there, especially with the lower end of the consumer spectrum being somewhat strained, given the exhaustion of savings and the impacts that they've had with inflation over the past year or so. But overall, we think the broadness can lift most sectors if we get an interest rate cut, perhaps starting in September, and if we get that downward trajectory of inflation pretty consistent from here through year end. So we're pretty optimistic, but we're looking for signs of that breadth improving as we go forward here that would make it a rally, not just of 10 stocks, but really of the broader market here.
Young-Yu Ma, Chief Investment Officer at BMO Wealth Management, many thanks for sharing your thoughts with us today. That is Market Insight. We have more videos on Reuters.com.